Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we would come to you today with a brief market update, kind of let you know what's going on out there. It is very quiet as we begin the month of September. S&P 500 right at about 6,400. That's up about 9.1% for the year. We're giving up about 80 to 90 basis points. That's 8 to 9/10% today. And a little bit of a sell-off in sympathy for what's going on over in some European markets, most notably the United Kingdom. Over in the United Kingdom, they are having a little bit of a fiscal, I don't know if you would really call it a crisis, but there's a significant amount of concerns around the amount of sovereign debt and their ability to support it. And their sort of 30-year bond yields are now the highest they have been since 1998. Obviously, 1998, a much different global interest rate environment than today. And so there's a little bit of agita, which is certainly going on in international markets, particularly around the UK. Some of that spilling over into the United States today. Not something that I would be super concerned with as we think about our own domestic market. And speaking of bonds, I would just note that our own 10-year yield is down right at about 4.27%, which is pretty close to the lows for the year. If you kind of look at the chart of the 10-year yield, it has been gradually moving lower over the course of the year. 4.2%, really pretty close to the low for the full year, which should be a little bit of an indication that at least the sort of fiscal concern that's going on over in Europe, not necessarily shared by investors in the United States. And so that is a pretty good thing. It is September, and so all eyes are on the Fed. There's about a 90% prediction, if you will, if you look at the interest rate markets, that the Fed will cut interest rates by about 25 basis points at the September meeting coming up here in a couple weeks. And, you know, that's kind of just widely expected at this point. I would note that the unemployment rate, at least right now, still sits at 4.2%. That's not too bad. The inflation rate in the core, that core rate that we always talk about, 0.3%, that's actually a little higher than normal. But what has the Fed sort of concerned is just the pretty rapid deceleration in job growth over the course of the past couple of weeks and months. You know, just looking at that employment number, the jobs creation number, not feeling great about where that is. So most observers believe, sort of based on Powell's commentary and everything else that the Fed has said, that the Fed is probably going to cut rates by about 25 basis points to just give a little bit of added stimulus to the economy. Not looking for a ton more than that, though. If you look at sort of forward interest curves for the rest of the year, you know, you're really pricing in a cut here in September and maybe one more cut by the end of the year, but not sort of an aggressive campaign to move rates lower. And I would just note, you know, if anything, the Fed would be making interest rates less restrictive. You know, if you think about the Fed thinking about interest rates, that this sort of 3% rate is maybe the neutral rate in the economy where you're not stimulating, but you're also not constraining. We're still in the constraint camp right now. You know, maybe by loosening by a quarter, maybe 0.5% by the year end, you take a little bit of constraint off the economy, and we will see how the rest of the year plays out. With that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.